what would you say is the mistake you made in hindsight and that you would try to avoid in the future?
Sure. So there's sort of 8 principles that have driven our investment success. And when we have veered from those 8 principles, we've lost money. And after the 2000, we went through a very difficult period, circa 2015, 2016. The 2 investments you mentioned were big drivers of that. It was if you will, experiences making mistakes and learning from them. And it was a moment of reflection for the firm. And I went back to the core principles that have driven our success for the first 12 years. And I had a member of the investment team literally engrave them in a stone tablet, not dissimilar from Moses' 10 Commandments. And I had that stone tablet put in what you might call a deal toy, sits on everyone's desk in the office. And we've adhered to those principles, ever since. And, we've been fortunate to return to the success we had for the first dozen years. So I think it's about keeping to our principles are basically, we want to invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management and good governance. Sounds logical, but occasionally we've diverged, and there's those times. There's a certain discipline that comes with investments, and there always seems to be a countervailing quality that caused us to diverge. But in really each case where we've compromised on business quality or complexity, we've been harmed from an investment standpoint.
The next president of the United States would be Donald Trump. He's going to be reelected. You know for certain. Would you short the market? Would you go long the market? What would you do?
It really wouldn't change anything that we're doing. Our strategy is to buy super high quality, dominant companies that can withstand a pandemic or a dramatic movement in interest rates that are not particularly exposed to the economy. So, who the president is, it's not something that we would make a bet one way or another on the portfolio. Okay. I started as an investor. I raised the first pool of capital when I was 26. And I made an early investment in a company called Rockefeller Center Properties. And I saw management making a series of decisions that made no sense to me. And it was just so obvious the right thing to do as to how to create value. And it was being a frustrated passive investor that made me into an active investor. And, that investment turned into a very profitable and very high profile investment. And with success, one is motivated to try it again. And it's been helpful to the strategy over a very long period of time, and it's fun. And if you're passive, you can feel like the market's patsy, and if you're active, you can actually create some value. And I think it's a lot more interesting than just picking securities. We bought a stake in Chipotle at a time where the company was struggling a few years ago. We put a few directors on the board. We recruited a new CEO named Brian Niccol. It's completely turned around the company. The stock is, almost tripled in the midst of a crisis. And it just tells you that, that's a lot more fun and it's a lot more profitable. And it's, I would say, that a lot more good for America than just simply being a passive stock picker.
Can you explain that? Why the market seems to be so much higher than the economy is?
Sure. So, when people talk about the market, they talk about either the Dow or the S&P 500. And the S&P 500 is a market cap weighted index. And what's interesting or fortunate and unfortunate about the crisis is it affects different companies differently. And the more dominant large cap, companies, the stronger the balance sheet, the stronger the market position. Those businesses are huge beneficiaries of the crisis. And what the market does not reflect are small businesses, private companies, more levered businesses that don't have access to capital, don't have the same dominance as the public market. So a business like Amazon, which is a very big component of the market, is up 45%. That does a lot, obviously, for the averages. It's probably something approaching almost 10% of the S&P index today. My guess is 6-7 percentage points of the index. Businesses like Google, Facebook, I think long-term beneficiaries. And ultimately, the value of a business is the present value of the cash it generates over its life. And even if the cash flows are disrupted in the short term, if they're greater in the long term, the values will be higher. So I think the stock market is a snapshot of a portion of the economy. If if you had an index of smaller businesses, the market would be down 50, 60, 70, 80%.